Sachin Trivedi, the Senior Fund Manager from UTI Mutual Fund, joins us on the show right now. Sachin, hi. Thank you so much for making time and speaking with us. Let's begin by discussing the cement sector itself. One was hoping that perhaps this time it's going to be different. There was the expectation of perhaps some sort of GST tweaks, some trials made for a price hike, but they had to roll it back. What do you make of the prospects of the cement sector, and how are you positioning yourself for it?
Yeah, sure. Look, I think this is one space where we have seen quite a bit of consolidation, and I think larger players are continuously getting larger. Clearly, I think that's one space where near term, like your anchor said, and one of the analysts also said, near term, I think there are pricing issues, and it's not easy for the players to take the price hikes. At the same time, the cost tailwinds which were persisting, they are no longer there. So I think near term in this space, possibly we may have some issues with respect to profitability. But how I'm approaching this space is that going forward, we've seen clearly players are consolidating over a period of time. The space you will certainly see over a period of time, players will start to get this pricing power maybe 1.5 year down the line. And of course, second half, we should expect some bit of recovery. At the same time, remember, I think governments continue to push towards capex, towards building the infrastructure. And we are also in the mix of where the housing cycle is also underway. So I think there are a couple of levers for the space, and that's where we continue to remain neutral to positive in this space.
Right, interesting. Sachin, just a day ahead of the budget, anticipating whether the budget is going to be market friendly. What is it that you're expecting?
So I think it should be in line with what the government has been delivering for last 10 years, right? Which is towards building the nation for longer term, which will mean that there should be sufficient investment which should go towards creating infrastructure or promoting manufacturing in the country. Because remember, I think both state plus center accounts for, if you were to count overall capex in the country as 100, maybe state plus center just account for less than 20%. And the rest of that is coming from the private side as well as from the household side. So government has been acting as a catalyst in past years. I think that government should promote policies which actually encourage private sectors to do more capex. Remember, all the earnings growth that we have seen in past couple of years was on back of the capex that we have done in last decades. But if the companies are no longer investing, or maybe the investment phase is less than expected, at some point in time, earning growth will also slow down, which is where I think policies towards promoting capex in the country or promoting manufacturing is required, which is, I think, in that direction, not just the government has been creating infrastructure, but they're also encouraging policies like production link incentives policies. So I think I expect the government should work in that direction. I am not in the camp that there will be a lot of money which will be spent towards promoting consumption. Maybe in a measured way, government is already doing it, and I think even the state governments are doing it. So I think the central budget should largely be accounting and what they have done in past. I think they should be on in line with that. And of course, one very important thing which I forgot to mention is that the part to fiscal consolidation. I think that should continue. That should continue. Yes, there is this RBI dividend benefit which is there, which should help the government to promote some extra capex. That should continue.
That's interesting, and that's the take as to what the budget will really entail. But Sachin, if I had to ask you for the top, overweight ideas right now, or which spaces look good for fresh investments, which themes or sectors comes to mind?
Yeah, so I think when I'm talking about this, I think the valuation and what the companies have done in past is always come to the mind, and which is where I think I still find that spaces like IT, which is where the commentaries have just started turning positive for the companies, and we've seen. I think this is especially in the IT space. We've seen last good 5 or 6 quarters where the earning, or at least the top line growth, was quite muted for the company, which is one of the unique in last one and a half whole of decade. So I think the commentary has just started turning positive for the companies, and I think this should be at the turn, and I expect that the growth run rate should pick up from here on, and margin should again pick up after that. So this is one space where we continue to remain positive or overweight as far as this is concerned. The other space where the valuations are quite reasonable and earning delivery has been quite robust is the private sector bank. Again, if you find the valuations are maybe below their longer term averages, and that's where private sector banks actually clearly fall into this space. Lastly, maybe I'll say that consumer services and especially the consumer durable as a space should start to do well, because we've seen for last couple of years the housing cycle, especially in top 10 cities, has been doing better. Now, as the construction come to closer to possession space, is when you will see there will be a lot of demand which will pick up. So I think that's one space. Consumer durable is one space, and I am positive. And of course, weather-related issues are also helping demand in this space. So that these are the names where or sectors where I am positive.
And at the same hand, where is it that you think that valuations have run up ahead of what the fundamentals of the growth trajectory is?
Of course, we have to be quite mindful of the fact that, and of course, this is very much debated across various panelists that you would have in past, is this mid cap versus small cap. I think that's one space where we need to be careful. And if I just look at the valuation in terms of price to book, so there are various ways you can justify the valuation. Maybe somebody on the if somebody is looking at from the price to earning basis, he or she may have a different view. But when we purely look at from the price to book perspective, what clearly it is established is that both the mid cap and the small cap name or the indices actually are trading at close to 90% premium to their longer term averages. Of course, large caps are also expensive by 25%. But clearly, mid and small cap is one area where we need to be quite careful. Having said that, I think, of course, I said that capex we need to promote, but we have to be mindful of the fact that what is the earning delivery and what are we already building in some of the names, which is where when I look at some of the small cap capex names, I think those are the area where I would want to be underweight. Because there is definitely in past cycles when I have seen, there is definitely gap in between what the market is probably expecting and at what phase the growth may take place. So I think there can be some lead lag, and having looked at that, I think that's one space where I would be underweight. Maybe the other area, clearly oil and gas. I think there we've seen quite a bit of good run up in some of the oil marketing companies. Again, that's one space where I would remain underweight. And lastly, FMCG. Here, maybe the debate is whether the growth will be 5-6% or 7-8%. That's the level of growth, the debate. But I don't expect the double-digit kind of earnings growth in this space. So, given the valuation where there are, I would maybe underweight is the position which I maintain in this space.
On that note, we let you go. Thanks so much for making time and speaking with us today. But in the meantime, you have numbers for BPCL hitting the screen, and overall, it is a bit of a somber reaction coming in, at least to the stock. It's actually taken a knock of almost 4 to 5%. Maybe the fact that even Sachin was alluding to that these stocks have run up quite a bit higher, factoring in a lot of positives, that might be at play, and there might be some profit booking, even though the number is slightly off expectations as well. At least that's what we understand. Refining margin at around $7.86 per barrel. We'll get you more details after this very short break.
If you like this video, then like, share and subscribe to ET Now.